Hello everyone. We're gonna just wait a few more minutes and let people join. Say hello to me if you're joining the webinar. I mean the Facebook Live, YouTube. If you're listening to me on YouTube, Periscope. If you're checking me out, make sure you say hello. Give us some likes. Today, what I wanted to do actually, because I got a lot of questions on my on last Sunday regarding the information that I shared. So people sent me some questions that they wanted me to address. So I'm going to address each one little by little, not all of them, of course. One somebody wanted to me to clarify again the they say using life insurance and credit. They didn't understand how that kind of plays hand in hand, and what I was trying to explain there. So I'm going to actually go through that again and help you understand it a little bit better, so you kind of see some of the things that you could do with your life insurance policy if you have one. If you don't, that's okay. We could set one up for you that you could start using like your own bank, like we preach all the time. The other question was liens and collateral. Most people didn't understand what that means. So I'm gonna kind of address that, help you understand it, because I want you to know it, because I believe once you know it, it makes life a lot easier for you and your family. So I want to make sure that you understand very well one thing that is available to you. So the what I wanted to do is just kind of make sure we got everyone listening and getting in. So make sure you let me know if you could hear me. Hey Louis, how you doing, sir? Hey, we're going to be hearing you soon on the radio show in a few. Hey, yeah, folks, don't forget we got a radio show tonight at 7 p.m. in another, what is it, 30 minutes, actually an hour and a half. It's 5:30 now where I'm at, so we're going to be on there soon. So make sure you join us on that. But let's go in there real quick. So I want to kind of address some of the things that I talked about last week and help you understand it a little bit better. And I'm going to take it slow because people said, "Man, I went too fast." So let's get there. So let me bring up my PowerPoint real quick, and I'll start with the credit companies. Let me see here. What happened here? All right. So let me explain this first, because this a lot of people had questions about the credit card. So in this example here, what I was saying was, if you have a $10,000 credit limit, okay, and you've maxed out, you owe the company $10,000, the credit card company, they're making money. They're charging you 18% interest rate, and and you're making your minimum payment. So this is the minimum payment, $250 is what they're asking you to pay them. If that's all you did, so let's kind of see how they break that down, because I need you to understand this, folks, because this is how the banks make money. This is, let me calculate that out real quick and give you an option there. All right, so it's recalculated. So here's the deal. If you just pay the minimum, we all know this, right? It will take you 342 months to be rid of your debt. In that time, you would have paid back the bank $14,000, 423. So they made $4,000 off of you, off of the 10 grand that they gave you, and they made extra $4,000 off you. Now you pay them 250 for the month. $150 of your 250 goes towards the interest. Only $100 goes towards the principal. So each time you send them the money, that's how they divvy it up, of course, and they subtract something. But this other one here is 350. So you go talk to the bank and say, well, you could make extra payment of $100. So let's look at that. So I'm going to do the fixed payment of so now I'm sending an additional $100, because my thing is, you got to build your wealth. Your credit, you already owe them the 10 grand. Your credit already where it's at. It ain't changing, so it's what it is what it is. So in this case, you're paying them the 350, okay, and again they still take the 150 goes towards the interest, and $200 goes towards the principal, because remember, you have the $100 addition that you're giving them. So in that example, you're going to pay this off in 38 months. So what would most people do? They'll start doing that. But my problem with that situation is $100 extra that you're giving to the credit card company. That's your wealth. That's your money. That's your money. Why are you transferring your wealth to the bank? You already owe them 10 grand. You're already paying the 250. I'm not telling you not to pay it off, but I'm going to show you a different way to do it without you having to give the bank all your money, because you got to be rich. And then I'll show you the way you pay it off. So let's go into that. So now let me pull up my PDF with the life insurance real quick to help you with that. So let's see. Hope it comes up. All right, great. It's right there, folks. So I got it. Let me get it on my screen. I know you guys can see it, but I can't see it right now. So let me minimize this so now I can see it. Okay, great. I see it now. So here's the deal. So you got you have an account, and I use $5,000 because I know you might say, well, $5,000. Well, you listen, $5,500 a year. This is a 45-year-old. If you're 45 years old and you cannot save $5,500 a year, well, you have a financial situation. You have an issue. Something is going on with you, because if you cannot put away $5,500 a year, and I see you riding around in a BMW, Mercedes Benzes, and you have cable at your house, that's a big problem. So if you cannot save $5,500, you have issues, because one, this $5,500 gives you immediately a life insurance cover, which is still not a whole lot. I know you all can't see it, but if you look on the side, it's if you pass away that year, your family gets a check for $123,513. Again, it's not a whole lot of money, but guess what it is? It's going to take care of some bills, because there's some people that don't have $50,000 in life insurance. So what am I saying here? What I'm saying is, you putting away $5,500 a year in your insurance contract. Okay, now in 3 years you decide, you know what, because remember the example we're looking at earlier with the bank, they said it's going to take you 3 years to pay off your credit card if you pay extra $100. Okay, you're already contributing $5,500 with your life insurance. A lot of you have the wrong type of life insurance, but if you have the right type where you could save money and it earns interest, in this example, this person is putting $5,500 a year away every year. In year 3, let's look at the accumulative value. So now let me educate you all on these two right here. There's what they call accumulative value and the cash surrender value. See, if you're talking to the wrong insurance agent and they come to your house, they're going to tell you, well, your cash surrender, this is what you get. If that's your money right there, you don't have no money. That's a lie. This is your money. The one that says accumulative value is your money. That's the money that the insurance company is saying you've made interest after they take their fees out. Because remember, there's a life insurance tied to this. In this case, it's $118,000. I know you all can't see that on the screen, but it's $118,776. That's the death benefit. So think about this for a minute. If you're with a traditional bank and you put away $5,500 in your bank, right? How much do you get if you die? $5,500. Well, I mean, your family gets $5,500. With life insurance, they'll get the $4,773 plus the 118, which comes up to $123,513. They get both. So not only do they get the death benefit, they also get the accumulative value. The cash surrender value is the amount the insurance company is saying, if you decide to cancel the policy today, we're going to go ahead and give you back $2,741 for canceling the policy in year 1. If you notice, folks, each year that you keep the policy, the cash surrender value is going up, and you're not going to see. I know here in year 3 it reduced to $1,800, and I'll tell you why, because it's a loan that took out. So we won't talk about that in a minute. But let's look at the accumulative value. See how that is increasing? After a while, they even out. See that? After the 10th year, on the 11th year, it becomes the same. See that? That means you could cash surrender. You could cancel in 11 years and walk away with all the money you have in your accumulative value. Now, understanding what we mean by surrender value, what I say is this. This is the money that the insurance company is also saying, if you decide you want to take a loan from us, we could loan you up to the 2741. You could take a loan from us up to 2741 against your 4,731. So in this case, this guy puts in 10 grand. I mean, he takes a loan out from his policy for $10,000 to pay off that credit card. Because he's like, you know what? This is year 3. I want to pay off the credit card. I just want to go ahead and write a check and pay off my credit card. He just wants to do that. One second, folks. I'm multitasking at the same time, trying to get the right screens for you. So he wants to pay off his credit card. So his credit card, remember they said he has 38 months, which is 3 years and 2 months to pay it off. But he decides, you know what? I'm going to use my life insurance and pay it off in 3 years. And he decides to do that. He cuts a check for $10,000 with the insurance company, gets them, they give him a check for $10,000. He takes it in the eyes of the insurance company, it's a loan. You see where it says annual loan? That's what the insurance company call it. In the eyes of the IRS, let me repeat that. In the eyes of the insurance company, it's income, annual income. In the eyes of the federal government, IRS, it's a loan. So they're charging you interest on the loan, 4.21%, which means you're going to pay the insurance company back because you're taking money from them. But folks, look at that. See, the 14,000 continues to grow. 20,000, 26,000, 31. You didn't touch your accumulated money. That's your value. You didn't touch that. That didn't reduce, right? See that? The only thing that went down was the 1860, the cash surrender value, because you just took out 10 grand. Now, folks, he decides not to pay back the loan. So in the eyes of the credit card company, now he doesn't owe the credit card company anymore. He's done. He's finished paying them because he paid off the credit card debt. He don't owe that debt anymore. So what does he do now? He says, okay, now that I paid off the credit card company, I don't owe them that money. So what I'm going to do, I was supposed to be paying extra $100, which I was saving all this time. Because remember, he didn't put that extra $100 with the credit card company. What did he do with it? He just went ahead and continued saving that money. He was putting that money away in an account. It could be his savings account, it could be his checking account, whatever. And he kept that additional $100. So he didn't give the credit card company $350. He only gave them $250. Okay, that's all he did. Just give them $250 to make his payment, his regular payment. And that's all he did. He just said, you know what, I'm just going to pay them the extra $250, and that's it. The $250 every month and pay this. Yes, it's going to take me a while to pay it off, 62 months, but I'm going to be okay because I'm going to pay it off in 3 years. And he took the extra $100 and puts it into his insurance policy. Into a checking account. So in year 3, which is he waited 1, 2, 3, he cuts a check from that checking account, $6,000, folks. So remember, he was putting away $100 a month, times 12 is $1,200, times 3 years. That gives you that amount. And he takes that and he dumps into his insurance contract to pay down this loan. He pays down this loan, and he also has additional monies that he added to this. And then he pays down the loan and starts putting away $1,200 every year for another 5 years. But at the end of the 5th year, he only was allowed to put in $646 because he's already paid off the credit card in the life insurance contract. The good news here is he transferred his credit card debt from the credit card company to the life insurance company. But why would he do that? Well, because now the credit card company reports his account is zero balance, which helps his credit score, right? And the life insurance company, they don't report this money. Nobody knows he took this $10,000 out. They don't know he took that 10 grand out. It's not on Equifax. It's not on TransUnion. It's not on, Experian. Nobody knows. And 2, the second one is he doesn't have to make a payment. If you notice, the first 2 years, he's not even making any payment on here. He didn't put any dollar in here. And then on the 3rd year, he decides to put in 6 grand in there. So if you notice, for the first, how did he come up with 6 grand? Well, each year, 1,200, 1,200, 1,200, 1,200. And last year, he just dumped the whole money that he's been saving. Because he didn't put it with a bank, he saved that. And then on the 5th year, he just took $6,000, wrote a big check, paid off his credit card, and dumped $6,000 in, which reduced the amount that he owed the credit card company. Now, in this case, the insurance company. He don't owe them 10 grand. Now he only owes them a few dollars. And he goes what? He pays another $1,200 every year because he continues contributing the $1,200 into his insurance policy to pay down the loan that he took out from the insurance company. And then at the end of 10 years, he's paid off. he only ended up paying the insurance company $1,447 in interest. And the insurance company is happy they got their money. Two, his account value is back to where it's at, $67,922. He could take a loan out. Now look at the beauty thing of the most beautiful thing about this here. Even when he didn't make a payment in year 4, see, zero cash loan repayment, he didn't pay anything. The insurance company still say, hey, if you need additional $7,000, you could take it from here. So if there was any money left over in the account here with the bank, if there was any money left over, he could have taken on that cash and just paid it off quickly and just owed the money to the insurance company if there was any money left over. But since there was no money left over, all he did was put his rest of his money and paid off his credit card. In the eyes of the credit card company, he don't owe them anything anymore. He's transferred that debt to somebody else, in this case the insurance company. So I hope that helps you understand that a little bit. But the key benefit here is this: if you pass away while this is happening, your family still gets a check. Let's say in year 7, his family will still get a check for $154,007. That's how much they'll get. $154,000 if he dies. That's a big deal. If, on the other hand, if he was just paying his credit card, what would they get? They'll just get debt and no wealth. See that? So it's so important to understand how you transfer your wealth. So let's kind of come here again and let me bring this other picture up for you. So let's do this way for you. So this picture you're looking at right now, as you see it, as you're coming online, this picture that you see is what I call your personal economic model. Okay, those people that understand this use it to cultivate a lot of wealth. The people that don't understand this live paycheck to paycheck. So let me paint a picture of that. So we make money, two ways. We earn the income. Some of us, some people getting social security income or other sources. But most of us work and earn income. Have a business, you're earning income. But what happens here is this, folks. What happens here is while you're earning your income, this big tank right here, this is all the money you're going to make in your lifetime, right? That's all the money you're going to make. That's why this tank is bigger than these 2 tanks. Okay? But most folks, your company is not going to give you all the money at once. They're going to give it to you little by little every month. So you like, man, my paycheck is very small. But before it comes to your hand, the IRS is going to take taxes out, right? And the tax eats it. If you don't do anything, it's just going to flow through your lifestyle regulator, and it's going to go through your current lifestyle, and it's gone. Because what are you doing with your current lifestyle? Because you're living with it. You're traveling, you're buying cars, you're doing different things. Especially for those of you that build money up in your savings tanks, because some people have money in savings because they're able to say, you know what, I'm going to save some money, and they put some money in their savings tank. But unfortunately for most is they dip into their savings and now they don't have any more money. Now, this one here is your money in your qualified plan. Because again, as you make income, what do most people do? They make their income right away. They say, well, I need to save in my 401k, and they take money and they contribute to their 401k tank, right? Again, we're not saying it's a bad thing or a good thing or whatever it is. We're just saying you're contributing in there. But unfortunately, most people cannot even access the money, because if you touch it, you're scared. You're scared because you're like, man, if I take this money, the IRS is going to tax me on that, right? So when we look at that, how much of that money belongs to you? Well, this red part determines how much the IRS takes. The yellow one is your money. Now, unfortunately for so many families, this is all where they have their money in this tank. Now, if you notice, this tank doesn't even have a cap on it. That means, and it has a big word that says risk, because you could make a lot of money. You could also lose a lot of money because the market goes up and down, right? And, and if you notice, see how the red one is going up as your yellow one is going up? The red one is the taxes that the IRS hits you on it. And unfortunately, you don't have to pay it right now. You got to pay it in the future, which also means the more you make, and we know based on what's going on in the economy, Are taxes going to be high, lower, or higher? Well, we both know it could be high. So depending on how much money you have in this tank determines how much taxes you're going to have to pay. So many families have this. Now, when I talk about using life insurance as a savings account and also as an emergency account, here's the reason. Because I believe if you save your money up in this tank right now, unfortunately, the problem with this is if you pass away, this is all your family gets. And if you're not structured well, which means you don't have a trust or will or any of those things, guess what? All this money goes through probate court. This is probate, subject to probate. But a lot of people, when they want to buy something, when you're making money, you have a full-time job, right? And you make your income, you dump money in your 401k, and then the rest of the money goes through your lifestyle monthly. And guess what? You pay taxes, and the rest goes to your lifestyle regulator. You save it. You worked hard to save the money, and you put it into this tank. The problem with folks is when it's time to buy a car, and they listen to somebody on the radio that says, you know what, you need to pay cash for that car. Guess what they do? They go on and they dip money from their savings. Your uncle or your brother calls you, hey, I need money. You dip money from your savings. Single guys, your girlfriend calls you, I need some money quickly, pay my mortgage. You say, okay, you dip money from your savings. Why? You don't have a mortgage, but your girlfriend got one. You paying her mortgage. I don't know about that. Well, it's what it is. And guess what? By the time you know it, your tank is zero. You have no money in that tank. And you're looking at everybody else like, what's going on? Because you have what they call the put and take savings account. That means you put it in and you take it out. Put it in and take it out, savings account, which is what happens to so many people, right? So here's what I show you to do. This is why I love our life insurance. Because first of all, with a life insurance contract, this is what happens. You have something else that comes in, which is called a death benefit. And in this case, we're not saying don't do the same thing. You're going to do the same thing you want to do, but now you're going to use the insurance company money. Like that example I showed earlier. He's going to borrow money from the insurance company to pay off his debt. He takes money from them and he pays off his credit card while he continues to save money in his tank and with interest that the tank is earning. Now, if anything like that should happen, guess what? He has a death benefit plus all the cash. Because somebody asked me about a lien. Well, see, the insurance company put a lien on this account. So let's say this account was $100,000 of cash value. All this green tank was $100,000 right here. And he needs to pay off that 10 grand, and he borrows from the insurance company, takes their $10,000, like the example I showed earlier, takes $10,000 from the insurance company, pays off the credit card company. Now he owes the money to the insurance company. The insurance company is who he owes now. He don't owe anybody else. Just the insurance company is who he owes. Now, he could owe them some more to borrow, but you know what? The insurance company never bothers you. They don't ask you to go to Equifax. They don't report you to TransUnion. They don't do any of that because they know one day you're going to pass away. The day you pass away, they'll take their money, which is the one, and yours, which is the collateral. They'll take that, but then they'll pay the rest, whatever you have left, which is this amount here in your cash value, plus the death benefit, depending on the type of life insurance you bought. Depending on the types you bought and how it was designed. That's why you got to sit down with an expert that understands insurance. Not just because somebody say they got an insurance license, don't mean they're an expert in it. You got to sit down with someone that understands this stuff, that can explain it and break it down for you. And there's different types of insurance policies: whole life, universal life, index universal life. So it just depends on the one you decide to get. So I just wanted to kind of give you that education real quick. I don't want to spend too much time on this. And, I hope this helps you out. If you have a question, like I said, let me see if anybody has a question for me. If you have a question as you're watching this, just, hit me up, let me know. And we'll be able to answer it for you. So I hope this makes sense. If not, send me an inbox message. Let me know, if this was able to bless you. Again, for those of you that are on YouTube, make sure you subscribe to my YouTube page. Make sure you subscribe to our YouTube page so we could continue, so you could get all the great information that we're sharing out here. Make sure you subscribe to that. on Periscope. Make sure you continue to share and like it. And Facebook, folks, you all do the same thing. Make sure you share it, like it, and let people that you never know who you might be able to bless with this. So I hope this answers your question. The person that asked me about the lien and the person that asked me about the life insurance and credit. So you see how you could use life insurance to rebuild your credit and still be wealthy while doing it, which is key. That's why we always talk about you're still building your wealth while you're paying off your debt. See, my point, my whole idea is a lot of people pay off their debt and they're still broke. So guess what they do? They go back and they recharge all over again. They start from square one. So my key for you, my benefit to you is pay your debt while you're rich, while you stay rich. Don't pay off your debt and be broke. Don't transfer your wealth away to the banks and stay broke. You could do it a different way, a different style, and there's lots of ways to make sure you could save and do what you need to do in an account that's flexible and has power. Again, thank you so much. If you reach me at 301-220-3555, you want to set up an appointment, so we could do a webinar or sit down and talk about it. If you have personal questions, we could talk about, and I could help you with that. 301-220-3555, and or send me an email, douglas@lagofinancialservices.com. And you could go on my website as well and get some more information that will bless you. All right, with that, you all have a great week, and bye-bye. See you at 7 p.m. tonight.